Welcome, everyone. It's Angelo Robles to the Angelo Robles podcast. I'm also the founder and CEO at Family Office Association. Today, we're covering direct investing, specifically in multifamily real estate. So, in scouring the world about 2 or so months ago for who would be someone interesting to have on, who's dynamic, who's been successful, who's a creative thinker, and effectively, in his own right, as an investor in a family office, I was introduced by one of the members of Family Office Association, a single family office, to Eric Barvin, who is our guest today. He's the CIO of Barvin. Eric, welcome to the show.
Thanks, Angelo. It's good to see you again.
It is. So, to give the audience a little bit of context, I met Eric for the first time about a month ago at the Mandarin Oriental in Miami, where I interviewed him, and really looking forward to, in some ways, even a deeper dive now in my digital programming with Eric. Many of you are active real estate investors. Real estate over the years, over the decades, I guess you could argue small businesses, but has probably created more successful people and millionaires, perhaps not billionaires, but millionaires, than really any other asset class. There's regional knowledge that's incredibly important in real estate. There's opportunities for leverage, and there's opportunity for incredibly low interest rates. So arbitrage, as I would call it. So real estate can be a very intriguing investment. Why don't you tell us, Eric? I know this is going to sound like the ABCs, but I do think it'll add context to our dialogue. Why don't you tell our audience what you do?
Absolutely. Thank you. Today, we're a firm based in Houston, Texas, and we acquire, we develop, and we operate mainly Class A apartment communities throughout the Sun Belt. Our approach is very focused on demographics and location. So we tend to be very specific on the areas that we will invest in. As well, one of the key differences between us and probably other groups is that we tend to raise capital from high net worth investors and family offices on a project by project basis. So we're not a fund and we don't ask for capital commitments. It's just when we send out a new project we're working on, we have our partners say, hey, I want to participate, and they participate. And I guess another unique thing about our model is that I've historically, as Angelo referenced, been the largest or one of the largest investors in each project, which has been, helpful.
Yeah, no, I mean, being a direct investor, like you said, and not doing it through a fund, and nothing wrong with doing it through a fund. There's some great funds in multifamily, and for some investors that maybe don't want to be quite as hands-on or a variety of other purposes, that may be the better opportunity. But investing effectively alongside of someone who usually is the largest investor really is quote unquote aligning interest. Most of your net worth is in this, and you obviously want to see it be successful. I'm going to ask, and this is a little bit centric to COVID and COVID times, and probably a little more broadly than multifamily. If you want to answer it broadly in real estate, then bring it back to multifamily, that's fine. But why? Why should I invest in real estate today?
I think that the straightforward answer is that the US dollar tends to be losing its value. So by going into hard assets, there's a greater store of value in those. Today feels also very similar to me from when I started my career in 2009, 2010, coming out of the Great Recession, now coming out of kind of the COVID recession. There was fiscal stimulus to bring us out of that previous recession. The fiscal stimulus that we've seen in recent months is multiples of what existed then. And the results from that fiscal stimulus led to wage inflation and to asset inflation. And so we saw that translated from basically 2013 onward in the rents, in the values of our assets. And today we expect that very similar thing to happen. We've already seen it in rising material costs. So to give you an example, we purchased a property in downtown San Antonio in late 2019 for around $175,000 a unit. Today, to rebuild that property will cost you, if you can find the land, $240,000 per unit.
Wow.
So as those replacement costs go up, rents will go up in certain locations and certain demographics, and you'll see a closing of that gap. So anyway, that's why we think it's important to invest in hard assets at the moment.
Yeah, I really enjoyed your answer, and my audience knows me talking about that relative to the US dollar and losing value. You know, again, a family feels, well, I got 70% in cash and treasuries, and very few do that. But let's use that as the example. I'm not going to lose money. Well, yeah, you're probably not going to lose money from that money disappearing or going out, but you're going to lose a tremendous amount of purchasing power. You won't feel it in the first year or two. It kind of comes up quietly, like you're put in boiling water that you don't see boiling yet. But after a certain number of years, that money you had that you thought was generational over generation after generation, coupled with taxation, lack of proper estate planning, and coupled with the fact that you were uber conservative and didn't keep pace, your purchasing power is decimated. And it can happen quicker than you think. So buying real assets certainly is among several strategies, but one that could be very logical. Let's still go into a little bit that we're in COVID. I almost was tempted to say we're coming out of it, and in some ways we are. So let's try to be optimistic. But let's turn the clock back to the black swan of COVID, really only 14, 15 months ago, at least here in the US. And real estate was really at a pinnacle for the reasons I said earlier. You could buy on leverage. You could get great interest rates relative to the appreciation and the cash flows. And then boom, COVID-19 hits. And I think it's important to talk a little bit about families may have had diversity in office real estate, in residential, multifamily, hopefully data warehousing and storage and things like that. But there are aspects of your asset class deeper than multifamily that are severely impacted. Movie theaters, retail shopping, which was getting impacted anyway, office. And I don't see a lot of that really coming back anytime soon.
Yeah, look, I think that just to touch on your comment about it feeling very peakish going into 2020, I completely agree. And we actually sold quite a few of our legacy assets that were purchased early in my career. Going into that period, I sold a property in Dallas that I had bought for $15,000 a unit to a buyer for $125,000 a unit the week before the COVID shutdown.
Wow, good timing.
It's kind of I thought we were heading for some sort of crash. I didn't realize the impact it would have. As it relates to other asset types, office and retail, I don't think these are things that COVID necessarily killed. I think they were had structural changes prior to COVID existing, and COVID may have accelerated that time frame. So, things like this Zoom call we're having right now, a year and a half ago, Zoom existed, but it wasn't used nearly as frequently as it's used today. But by adapting Zoom at such a high speed, we have somewhat sped up the progress and somewhat of the death of the traditional office building to the traditional big box retail center through this COVID experience. And so I think you'll likely see things get repositioned. Obviously, in some markets, it's going to be harder if the industry isn't expanding, if you're not able to backfill those tenants. We're in Houston, Texas. There's a lot of oil jobs here and oil industry here. So our occupancy, I believe, in downtown Houston office space is very low, like in the 70s or the 60s. And Houston itself struggled to get that job base. And so I think it'll just take some creative landlords to figure it out. The bigger thing that's happened from COVID in our perspective is that there's a structural shift. away from those assets for institutional capital. So whereas institutional capital historically allocated to hotels and retail and office and multifamily industrial, as Angelo mentioned, data centers as well, that is going to change. And the allocations you see them put into hotels and retail and office will go down dramatically. And the allocation to assets that have performed throughout COVID will go up. And so we expect really to see continued cap rate compression. I know that sounds crazy, but there's so much capital that believes in multifamily, and multifamily is so well positioned for an inflationary environment that we think lends us to believe like that this is a permanent shift and not a situation where we're going to come out of it in a couple months and everyone's going to be vaccinated, and all of a sudden these big institutions are going to go right back to investing in hotel development. I think that's probably all for a while.
Yes, I would say so. And like I said earlier, real estate is so incredibly regional. I'm in the greater New York area. We met in person a couple of weeks ago in Miami. And again, some of these things were happening, like you said, but definitely COVID changed it. There's a hell of a lot of very wealthy New Yorkers and Northeastern folks in general that have migrated to Florida. You put your home on the market, especially in aspects or parts of South Florida, it may be on the market for an hour, a day, a week, and you're probably going to get 20 to 40% more than you would have got pre-COVID. There's a variety of reasons, openness, business regulation, very business favorable, quote unquote, and no state tax, warmer weather. And Texas, where you are, is going to be incredibly similar, especially the Austin area. Yet you look at markets in New York and San Francisco, I think those are amazing cities. I love them. They will rebound. They're going to be creative. Young people love it. There's great universities. Trust me, I know all the reasons. But there's a part of it that has moved to Florida, Texas, a little bit of Nevada, Wyoming, et cetera, forever. That's not going to change. So I find the whole dynamic really interesting. Talk a little bit about multifamily. The trends that I would see are millennials and Generation Z maybe get married later, probably fewer kids, maybe not looking, even if they have the capital to buy a home and settle down, want a little bit of fluidity or options. So it looks like the ratio of people that own home to don't. I don't know if that's going to get better, and that's going to make multifamily housing in the right location probably long-term, who knows, short-term, but long-term, a very solid investment.
Absolutely. The 2020s were positioned demographically to be the decade of multifamily and the decade of housing in general prior to COVID. So you're 100% right that there's a huge demographic wave from millennials to Gen Z of renters, and the renter pool is very strong. The marriage rates for women have, are happening at an older age. There's so much more to do in these cities, even in a city like Houston, from the restaurants, entertainment perspective during COVID, even during COVID. There's just so much to do with moving 40 minutes out into the suburbs for a lot of people just doesn't make sense for their lifestyle. So I think that you're spot on. We're seeing tremendous growth, exodus from California, New York, and Illinois into our markets. And I think the one thing that you have to be careful about is that it's really location specific, right? And that's really with what we do in our model is we are very particular on who our renter is, because we believe that the demographics of that renter, just like in other asset classes, like if you were thinking about a retail investment with a triple net property and your tenant was CVS and CVS always pays their rent, you would buy it at a lower cap rate than a hair salon. The same thing's true in the apartment business, right? If your tenants are all six-figure, highly educated income earners working in good industries at good companies, paying 10 to 15% of their income in rent, that in theory should sell at a lower yield. And so, but what I think happens sometimes is that there's money coming from these markets into a Texas or Georgia, and they say, well, I'm going to be in Atlanta. And they don't focus on the specifics. They say, I'm going to be in Atlanta. I want to get out of New York. I want to be in Atlanta. And that's where I think you can get into problems, because right now there's not a enormous spread between those two demographics in terms of return. So right. If you're going to go invest in a Walgreens at a 4 cap and the hair salon is a 5 cap, you would take the 4 cap of Walgreens all day. But if you're going to say, well, hey, it's an 8 cap for the hair salon, you understand your risk. Mm-hmm. And that's what's really, really got to be careful about today in multifamily, is the spread is not there. It's really a 100 basis point spread between the creme de la creme class A and the class C. And it's not a wide spread. And so I caution people to not just think about the macro, but to really understand the intricacies of the locations and demographics of their renter pool.
Let's dive a little bit into that. So you're obviously active in various cities and communities in Texas, I believe Georgia, specifically Atlanta. I wasn't sure about Florida, but talk about the markets you're active in and some of the reasons why.
So we take a very analytical approach to market selection, and we started with just the top 50 major metropolitan markets in the U.S., right? And used a filter system to kind of go from 50 to 9, just to kind of give you a sense of some of those items. Landlord laws are important to us. Rent control, we stay away from rent control. We want markets where there's a high propensity for STEM jobs. We want markets where there's enough volume of apartments, because to operate apartments well, you need operational scale. So going into a market, like a good market, there's a few. Salt Lake City is a great market. Going into Salt Lake City, sounds like a wonderful idea, but getting scale in Salt Lake City is very difficult, because there's not much of a supply as a Dallas or a San Antonio or Austin or Houston or Atlanta. And so, it's very hard to get 4 or 5 deals there that you need to operate effectively. And I think that our target markets today are the big cities in Texas, Atlanta, Denver, Phoenix, Charlotte, and Orlando. And how we approach it is, again, very systematic, where we look at job data, economic data, and then multifamily apartment data to really define where our renter lives. So, as I kind of touched on earlier, we want a high qualified renter, someone who's paying 15% of their income in rent, earning somewhere between $80,000 and $140,000 a year, college educated, working in an upwardly mobile industry. We're not big. We fortunately don't own anything kind of oil and gas related in Houston, where the tenant pool is in oil and gas. But yeah, looking for those industries. And so that's certain submarkets in each of these cities. It's not going into Orlando and saying, hey, we want to be all over Orlando. It's saying, hey, we want to be in 1 or 2 submarkets where our renter is. And that's really how we approach the business.
Yeah, I mean, you gave a great example, I believe, at the physical event where I interviewed you. If you want to kind of share that, I believe it was in Atlanta, and it was very strategic, and a large corporate center or secondary Southeast location was going up with a major company, and how that improved the job pool for people. And that's important. And that's the advantage too in states like what you're noting, is things are looking upward, where in some other states, let's be honest, probably New York and California, besides much more, it's going to come across the wrong way, but favorable to the tenant legislation, also makes it harder, coupled with people that appear to be moving from those communities going to other states. But if you want to share the one in Atlanta, I think my audience would love to hear it.
Yeah, absolutely. Just to start, it goes with our overall theme, which is what happens around a property is more valuable than anything you could physically do to the property itself.
For sure.
So I think I used the example in Miami of, you can go into a rough neighborhood in Miami and make the property beautiful. You could make the toilets gold. You could do whatever you want. at the end of the day, you cannot change what happens around you, right? We focus on locations where there's change going around these properties. There's investment, public or private, that will increase jobs and that will encourage more people to live in these areas. So the example in Atlanta was we actually bought the property from a private equity fund that was forced to sell. This is kind of our style. We like buying from motivated sellers who are thinking on a macro level. Their capital came from the LA County Pension Fund, Lacera, and Lacera was over allocated to multifamily at the time and said sell. And so the private equity firm said sell. We ended up buying it for about 3 or 4 million less than they paid for it a few years before. And right next to the property was a 2 million square foot headquarters for State Farm for the Southeast. Mm-hmm. And it was going to have 8,000 employees there. So what happened was they were forced to sell at the wrong time. There were apartments around them in lease up. There were a lot of concessions. I believe we bought it with over $1 million of concessions in place. And they could not kind of see the end, which the end being there's no more sites in this area to build. And you're going to have a pretty good runway and basis for the next 3 to 5 years because it's so hard to build around and you have this huge employer coming in. And so what happened was we owned it. A year later, there's no more concessions. So you basically add $1 million to your bottom line. And the State Farm building was finished and the employees moved in. And, you know, obviously COVID, they work remotely, but a lot of them are still working in the area. And, you know, the property has done extraordinarily well throughout COVID and it's probably gone up in value $30,000 to $35,000 a unit in only a couple of years. And so you know, this is on 360 units. I mean, this is a big property. And so it's about, again, what happens around you that is so valuable and less about, I mean, it's not to say, look, I've done a lot of renovations and a lot of value add when there was real value to add. It's hard to do, you know, we've sold properties where we've already value added them and we sold them to buyers and they're going to do something else to them. And, you know, I always ask, what are you going to do? And we're going to, you know, change the cabinets or, you know, put black appliances and increase the rent to $100. And my argument is always, you have to watch the residents' incomes because if the residents already paying 30 or 40% of their income in rent and you're going to try to get another $100 a month from them, that's a tough ask. And so, you know, our belief is again, all about the resident profile.
For sure. I'm going to ask you what I think is a tough question, because I'm probably going to have follow-up based on your answer. So if I'm looking at tying up my money being illiquid, but hopefully getting the kind of return and the diversity in my portfolio, which appears on the surface to be logical in normal markets during or buying multifamily. And I know we gave the arguments why during COVID and coming out, multifamily still looks good. But I think there is some bigger issues that an investor would need to look at. And that mainly is going to be around the groundswell, especially with the millennial and younger audience, of effectively the hashtag no pay culture. Many of them kind of grew up during the crisis of 07 and 08, and they remember, I know because I talked to them, these big banks and institutions, they completely messed up and the government bailed them out. They didn't have their feet held to the fire for the most part, true or not, it's their perception. And now in COVID, with some federal mandates and from governors of states, it looks like people, if they elect not to pay, I don't know if there's much you could do about it. How do you deal with that, investing in multifamily housing?
Good question, Angelo. So we fortunately have been pretty blessed to, one, be in Texas for the majority of our assets, and two, the quality of the tenant profile again is a little bit higher quality. We have some legacy kind of properties that I purchased early in my career that are workforce housing, and without a doubt, there's much more of a no pay kind of situation with those properties. But with the Class A properties, everyone pays. We haven't had a problem at all with that no pay culture. It could have a factor of our locations. I know in California, the mayor and the governor came out and said, don't pay your rent, which obviously is not going to be a helpful comment. There is a national eviction moratorium, which I guess was just repealed yesterday. I'm still trying to understand what that means for our business. But the national moratorium does require some proof that you cannot find employment because of COVID, right? So it's not a situation where you can just kind of throw your hands up and say, I don't want to pay. Now, if there's a local jurisdiction, so in LA, there might be a local thing that says you don't have to fill out this form, or that there's additional levels you have to go through. But in our markets, at least, if they're not going to pay, they would have to fill out a form and show proof that not only are they trying to find employment, but that they are trying to get rental assistance to help them pay their rent as well. And what we've found in the limited cases that we've had is that there's two kinds of renters. There's the renter that lost their job, that got their hours cut or something, again, mainly in the lower end properties. But those renters are essentially coming to the office and saying, I lost my hours. I'd like to create a payment plan and work with you. And obviously, in our situation, we're very big on customer satisfaction. So that's a no-brainer for us. The others, there's definitely a small portion that they just don't pay, and they don't communicate, and they may be going to work. Who knows? We have no idea. And their balances are getting to be enormous, right? And so, look, there's a small sliver of that, nothing like you would see in a California or some of these other markets. But again, if they're going to stay there, they have to fill out that CDC form, and we can still challenge those forms as well, which we do if we feel like it's not an honest submission.
Maybe more so in the New York area. So to balance what some people may perceive as my comments and think of it the wrong way, there are absolutely white collar professionals making very good living that I know from real estate owners that I know in New York that just aren't paying their bills. They could, they're electing not to. And they feel like the consequences are really like, they don't have a personal sense of responsibility. That's a little sad. But relative to the state where they are, being very consumer friendly from that perspective. So, trust me, there's all sorts of people, quote unquote, not paying their bills. Let me reverse that question, though, representing the consumer and a little bit more from someone like owners like you. What they're also going to say, and this goes back a little bit to the crisis in 2007, 2008. Well, you want me to pay my rent, but you're not paying your note on the loan because you may be getting special benefits, tax benefits, government dollars, or your note holders giving you a great ride. So I deserve the same thing. What's the truth behind that, and where are there some falsehoods?
Yes. So in loan, we don't have any loans that are like in that sort of program, but in loan forbearance, you owe the money. So it's not a situation where they're forgiving the debt service payments. If you can't make them, then they accrue and you owe them. Also, lenders do require you to prove that you can't make these payments. So it's not just someone submitting saying, oh, by the way, Fannie Mae, I don't want to pay my mortgage right now. I believe they put a lockbox in your checking account. They go very in depth into your financials. You have to prove up the reason why you're going to go into forbearance. So it's the same. Look, on the tenant side, it's the same. All these white collar people that you mentioned in New York who aren't paying their rent, they're still going to owe the money. And that will be a bigger question of what happens when someone, after a year owes $40,000 or $50,000 in rent that they haven't paid. Does that go on their credit forever? Again, I think that's a question. At this point, it does seem like the government has asked landlords to take on this burden, which, look, that's probably a debatable ask, but all you can do is make the most of it. And I will tell you, we made a transition in 2018 to these higher quality properties from a lot of workforce housing that we were doing and did still own some, sold quite a bit. And the reason we made this transition was because of the demographic and the location and the change in strategy. Obviously, when you're purchasing a property like the one in Atlanta that I mentioned, and we tend to be long-term holders of real estate, so we're not really flippers. But you know, it's that sort of property we underwrote a 10-year hold, you know, 2.4, 2.5 multiple, about a 12% LPIRR. And what a lot of people were doing in the value add space was saying, you know, I'm going to get a 25% IRR, a 20% IRR, 18% IRR. And when COVID happened, the properties performed poorly, and it didn't seem like those projects were going to work out as they intended. Still, I think there's questions around whether they'll work out as they intended. And the sponsors that I know who are in the space said, "Oh, you know, it's gonna figure itself out, and it's not, you know, it wasn't my fault or whatnot." And our perspective was like, it's an educated business, right? Like, you chose to go into that knowing the demographic was risky, and if you have a higher percentage of your demographic, your renter pool, that's not paying their rent, that was a risk you took on in the beginning, right? And so when your 25% IRR turns out to be a 12, and my Class A building that's well located also is a 12 that paid distributions the whole time, like, you know, I think there's a skill to this, right? Everyone's not created equal, and we've just we try to take as much. Look, our executive team has over 100 years of combined experience, so we take all this experience that we all have together and debate, but try to come up with the right strategy that really makes sure we're never risking anyone's capital, and that we're you know, conservatively using leverage to get to our returns.
And a little bit of a bigger picture macro question, but then tying it into real estate and some debate even among macro thinkers of the direction. But I'll ask it, is multifamily the right choice in a rising interest rate environment?
Yeah, I think it's a great place to be. The reason being is that you can change your rents. So, you know, leases are 6 to 12 months. And when the lease renews, you have an opportunity to increase that rental rate. We are seeing in some of our Class A communities, not on renewals, but on releasing, increases 10 to 15% in rental rates. Enormous increases. You know, that is unique with multifamily. Retail, office, you are leasing for years in advance, kind of on fixed schedules and whatnot. Hotels obviously is maybe considered the best because you're changing your rental rate every day. Obviously, when COVID happens, it's the worst. But you know, having the flexibility to do that is very valuable. And look, there's a few ways to finance as well, to kind of hedge yourself on rates. We bought a property in the middle of COVID in Dallas, and we locked in a 2.6% interest rate for 10 years. And you know, that's a great way to hedge yourself on inflation. And so there's other ways to do it with creative financing as well, on floaters and caps and whatnot. But we believe multifamily is a great place to be, and that over time, kind of going back to the construction cost item I spoke about earlier, you will see the overall values, especially of these newer properties, increase as construction costs continue to increase. The issue we've kind of had with historical properties, older properties, is that they're only getting older. So if you buy a 1970s property that's 50 years old, well, 10 years from now, it's going to be 60 years old. And regardless of, you know, the actual physical age, it's the age of the components, right, that lead to higher maintenance costs, higher CapEx, and you know, it becomes more an expensive thing to operate, which has a direct effect on your valuation. And so we're not so confident it will have the same impact on those kind of older properties, but the projects that we're building or buying today, we feel very confident in.
And another question, kind of somewhat in that direction, in a hyperinflation scenario, what happens if during this COVID era, depending on how it segues out, but that's going to be relative to our political environment and who's in office now as well. Remember, there's probably more renters and than there are quote unquote people that own the properties. So in theory, the votes are probably going to skew more to being consumer friendly, a little bit unique. I get it in Florida, Texas, and some other locations, but something to consider. Back to the question, in a hyperinflation scenario, suppose the government doesn't let you raise rents. Is that potentially a possibility? Then that could be a disaster.
Look, I think this all depends where your starting point is. So if you can only raise rents, 4% a year, and you're starting with a property that already makes 7 or 8 or 9% cash on cash, 10% cash on cash, maybe you're okay with it. I find it pretty hard to think that that would ever come to fruition. So maybe it happens in places like California and New York. Actually, it has happened in places like California, New York, but a national moratorium on rents, rent growth would be difficult, just because every market is unique and different. And I think that that was one of the telling things about this stimulus package, where they sent the checks out, was if you live in Manhattan and they give you $1,000, that's not a lot of money. But if you live in Brownsville, Texas, that's going to last you 4 months. So it's very hard for the federal government to kind of make these blanket things very effective. Everything's got a nuance to it, in my opinion.
Based on your transaction history, your experience of being a successful investor, and this is a bigger picture question, it doesn't necessarily, although it will come back to multifamily, what lessons have you learned in being a good investor and making decisions?
I've learned that, again, the macro of the area has an enormous impact on your specific asset. So watching for supply, watching for job, macro industry going up or going down, has a tremendous impact on your short-term value and can potentially impact your long-term value. I've also learned that it's important to put your money in the projects that you do. So like as I mentioned earlier, I'm typically one of the largest, if not the largest, investors in each of our projects, and that's created tremendous alignment. We talk all the time internally about, we're not a capital allocator. We're not making money by raising money. We're making money by making money for our investors. And by doing that, our investors' net return is better than going through capital allocators. I mean, that's just common sense. So
right.
That to me has been a big thing. And then this is probably not where you were going with it, but a major part of who I am is the philanthropy that I'm involved in. And I think that part of being a good investor is making money, is being a good philanthropist. And so that to me has been extremely important.
That's great to hear. And yes, a lot of our member families of Family Office Association are very active in the world of charity for a variety of reasons, mainly built around being a societal benefit and giving back. Most incredibly successful people that I know are appreciative, know that a little bit of luck was involved, and want to be helpful to their community, their country, and globally. And I would say, 97% of them are a big number. There's other tremendous benefits that may get a little off track to our core discussion, which we didn't even really get into relative to real estate, at least for here in America, but other countries have similar guidelines. There are some tremendous tax benefits, opportunity with 1031 exchanges, now with opportunity zones. I don't know if you want to, for those that may not be as familiar, give a little bit of overview of that benefit, whether they're direct owners directly or through an LLC or partnership like what you're talking about. But I think people gravely underestimate, and I said earlier, millionaires and people worth tens to hundreds of millions, a lot of it has been over time, the tax advantages and some of the things that I'm noting here.
Absolutely. I think the first thing to obviously highlight is depreciation. So one of the beauties of the Trump tax plan was that it accelerated depreciation.
Right.
So any depreciation deduction you were going to take over the first 5 years, you could take it in year one. So just to give you a sense, out of the property I mentioned and we bought in October in Dallas, I invested around $1.5 million. And year one, the loss was about $700,000. So there's a lot of value in that, right? You can use that loss for other similar K1 income. It's a very valuable. Now that does get recaptured when you sell, but time value of money just shows you how important it is. And with my investor pool, with our investor pool, and maybe some of your members will join it eventually. Most investors invest less. We always encourage people to invest less. Do not put too much in one deal, but do every deal. And so by continuing to invest, at least at the pace that I invest, you're getting those losses. And so when you have gains, they kind of offset each other. And so it's a very efficient way to invest capital. And what we say all the time is, if our project, the one I mentioned in Dallas, is year one will distribute close to 7%. That's 7% tax deferred. So that's almost like having a 10% dividend on a stock. And we haven't really touched on the REIT situation, but again, same deal where we use the depreciation to offset the dividends, whereas on those REIT stocks, those dividends aren't treated the same way.
And the VNQ, Vanguard, as a real estate investment, it's up above 10% this year. I think it may be at this point 12 or 13%. And it does pay a dividend, which I believe is a little bit above 3. That's completely liquid, and I get real estate exposure. Why would I want to be a direct investor unless I feel I'm going to get a noticeably greater return over time? And you may also talk about some tax benefits, but I am giving up a level of liquidity.
Yeah, absolutely giving up some liquidity. The tax benefits are enormous, like just similar to what we just talked about. We'll see what happens with the 1031 exchange, but just the depreciation alone is magnificent. And I believe that the Vanguard's distributing like 3% right now or something.
About that, yes.
Yeah. We're buying Class A, well-located communities and distributing, 6 to 7%. So to us, like, it's that combined with the tax advantage, combined with the just overall market knowledge. Our approach is sophisticated, right? We're patient capital investors. We can use our competitive advantages to win properties. And Vanguard is, it's a shotgun approach. It's not a sniper, and we're very much a sniper, looking to capture and create value in an expert fashion. And so, while you give up liquidity, you get a little bit more. You get a better quality product, and you also, in our situation, you get to choose, right? Again, we don't have a fund, so when you see something and you want exposure to Dallas, do it. If you already have exposure to Dallas, do the one we do in Atlanta. That's kind of how we're set up. There's positives and negatives to both, but we're very happy, and our investors are very happy with what we're doing.
Of course, of course. And, it's been great to have you on, Eric. And unlike some guests, like you said, you don't specifically have a fund. You don't even necessarily have a deal for qualified investors, even at the moment. You were kind enough to come on from an expert in multifamily. I'm getting a lot of questions from my audience, my members, however I define it. And real estate is very intriguing. And again, there are some tremendous advantages with leverage, with tax benefits. And, there's a reason why it's created more millionaires than probably any other asset class, at least investing in, again, other than creating your own business that becomes successful. But nonetheless, for those that would like to learn more about you, and perhaps when there is an opportunity, they may want to be on a list to be, raise their hand, so to speak. And again, I'm going to make the assumption they're sophisticated investors, probably a qualified purchaser and up. How could they learn more about the firm and reach out to, say, someone from your team?
Yeah, absolutely. So the best way is to visit our website. we have an investor website, invest.barvin, my last name, .com, or a general website, my last name, barvin.com. I actually purchased that from a Christian single, I'm Jewish, and a Christian single site had barvin.com, and had to buy it from them. Yeah,
They were probably tough negotiators.
yeah. You can also, I'm very easy to find on LinkedIn. Our director of investor relations, her name is Kate Schilling, and Angelo knows her well. We have a lot of information on what we're doing. We're actually hosting a webinar next Thursday as well. So more than happy to provide additional information to add you to our distribution list. Again, from our perspective, there's never pressure to do anything. And we realize that over time, there may be an interest, and we want to be there. Everyone wants deal flow. And so I think this is, I recommend signing up so you see the deals that we're doing. And again, there's never going to be pressure to participate.
Yeah, like I definitely recommend that. And maybe just to repeat it from, in case the sound was a little off, I believe you said investbarvin.com. Was that correct?
Invest.barvin.com.
Invest.barvin.com, and Barvin, B as in boy, A-R-V as in Victor, I-N. And did you want to give Kate's email during this presentation?
Tough. I don't want to misspelling her last name, but you can email me EGB, so elephant giraffe bear @barvin.com. I'm happy to speak with anyone. I talk to investors all the time. I will tell you, Kate has been with us for 8 weeks. She's a wonderful person that I'm sure everyone would enjoy talking with. But we've raised hundreds and hundreds of millions of dollars prior to Kate. And for that whole period prior to Kate, I was the only person speaking with investors. So I'm very, very confident in being able to handle any inbound requests.
Well, thank you, Eric. It's been great. I'll do a little bit of a close. Everyone, I'm Angelo Robles, host of the Angelo Robles podcast and founder and CEO at Family Office Association. Really enjoying these discussions with deep thinkers in the world of investing and beyond. And obviously, a lot of you own real estate. I wanted to have someone as intellectual and thoughtful as Eric, and hopefully you enjoyed discussion today. A little bit of macro, a little bit of broad real estate and some of the issues during COVID, but mainly focused on multifamily, which has been an anchor for many successful investors and usually kind of checking the box on a conservative part in real estate within their portfolio. So really, it's been great to have Eric on. A reminder, somewhat more focused on those that are family offices or at minimum qualified purchasers. This is sophisticated investing. You could always lose money when you invest. You need to do your own diligence and make your own decisions based on a variety of factors: time horizon, goals, risk tolerance, other capital, etc. But you should all know that already, but simply just a heads up. Think for yourself and make your own decisions, do your own diligence. I could be sourced very simply at familyofficeassociation.com, and in social media, probably recommend Family Office Association on Instagram, where I am very active, and probably my most active channel and most directly impactful to investing is on YouTube, and simply that's where many of you learned about me, and that simply is Family Office. You'll find it. Go and subscribe. Hopefully you'll enjoy it. It's been great to have Eric Barvin on, and look forward to talking to you in the future. Thank you, Eric.
Thank you, Angelo. Appreciate you including me today.
Pleasure's mine. Thank you.